Americans held $10.1 trillion in 401k plans as of December 31st, 2025. Total United States retirement assets reached $49.1 trillion, the highest figure ever recorded in history. And in the very same quarter that record was established, a record 4.18 million Americans turned 65, more than 11,400 people every single day. Demographers call this peak 65, and elevated levels are expected to continue through at least 2027. $49 trillion. 11,000 people per day pressing the exit button. A market more concentrated than the dot-com bubble and a withdrawal rate rule calculated back in 1994 that has not been updated in most people's financial plans since. This is not the same recession setup as 2008. It is structurally different in 4 specific ways that genuinely matter, and I am going to walk you through all of them using math you can run against your own portfolio. Here is what I am going to explain today. The retirement system functioned reasonably well when recessions arrived during the accumulation phase. You lose some money on paper, you continue contributing, you purchase shares at lower prices, the market bounces back, and you come out ahead. That entire playbook becomes completely useless. It actually flips into a negative the instant you shift from contributing to withdrawing. And right now, for the first time in American history, we have $49 trillion in retirement assets resting on top of a historically concentrated market at elevated valuations, while the single largest wave of simultaneous retirees in United States history attempts to pull money out of it at the exact same time. I am going to show you the 4 distinct mechanisms that make the next recession more hazardous for retirement accounts than 2008 was. And I am going to demonstrate with precise dollar amounts why the people closest to retirement are the most exposed and have absolutely no awareness of it. Think of your retirement portfolio like an escalator. When you are working and contributing, the escalator moves upward. A market decline becomes useful. You acquire more steps for your dollar. The escalator lifts you higher when it recovers. That is how compounding operates. But the day you retire and begin withdrawing, you are now riding that escalator downward. And the fundamental problem with riding it down is that every step you take permanently removes shares from the pile. A decline on the way down does not temporarily reduce your balance the same way it did before. It forces you to sell more shares to cover identical expenses. Those shares are gone permanently. They cannot compound their way back. The escalator is always descending, and the design flaw embedded in the entire system is this. You are sharing that escalator with 11,000 other people boarding it every single day. When everyone simultaneously hits the down button, the escalator accelerates in one direction only. I am going to return to this escalator throughout the video because it explains everything. In a few minutes, I am going to reveal something about how the S&P 500 is actually structured right now that should genuinely alarm anyone holding an index fund inside their retirement account. But first, let me show you why the sheer scale of this retirement wave amplifies every other market risk beyond what it would be in isolation. Between 2024 and 2030, an estimated 30.4 million boomers will reach traditional retirement age. 30 million people transitioning from net buyers of stocks to net sellers. That is a structural transformation in market flows with no historical parallel whatsoever. And here's the piece of context that reframes absolutely everything else. In 2008, when the last genuinely severe recession hammered retirement accounts, the people suffering the greatest losses were cushioned by a different financial infrastructure. When individuals in the peak 65 generation entered the labor market around 1980, approximately 60% of private sector workers relied on the guaranteed income delivered through a pension plan as their primary retirement vehicle, compared to just 4% in 2020. Read that again. 60% had pensions. Now it is 4%. The entire retirement system pivoted from the company guarantees your income for life regardless of what markets do to. Here is a bucket, good luck filling it. And by the way, you now absorb all the investment risk personally. The 401k was created in 1978 as a supplemental savings vehicle for highly compensated executives. It was never designed to serve as the primary retirement safety net for 160 million Americans, but that is exactly where we find ourselves. There is a person I want you to keep in the back of your mind throughout this entire video. Call him Dave. Dave is 58 years old. He spent 30 years in middle management at a mid-sized manufacturing company in Ohio. He did everything the brochures instructed him to do. He maxed his 401k contributions for 12 consecutive years. He moved into a target date fund when his HR representative advised him to. His balance reached $400,000 at the end of 2024, and he felt for the first time in his adult life like he was genuinely going to be financially okay. Dave is not a fictional character. Dave is the median. I will return to him. Stay with me because this next section completely transforms how you should think about diversification inside a recession environment. You assume the problem is that the market might fall. That is not the actual problem. The real problem is what falls and how much of your supposedly diversified index fund is actually one very concentrated wager right now. At the close of December 2025, the top 10 holdings of the S&P 500 represented 40% of the entire index's total weight. 40%. 10 stocks out of 500. The 10 largest companies expanded from 22% of the S&P 500 in 2020 to just under 40% today. That concentration has nearly doubled in just 5 years. Today's concentration sits well above the 27% peak reached during the technology bubble spanning 1999 through 2000. We are literally more concentrated than the dot-com bubble, and you own every bit of it inside your 401k. Right now, if you hold a standard S&P 500 index fund heading into 2026, the so-called Magnificent 7 stocks still account for roughly one-third of the S&P 500's total market capitalization, despite uneven performance throughout 2025. That concentration risk is beginning to unsettle some advisors who are repositioning their portfolios to defend against it. If you have $200,000 in a standard S&P 500 index fund, approximately $70,000 of that sits in just 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. That feels perfectly acceptable when those companies are rising. In 2025, roughly 42% of the S&P 500's total return originated from the Magnificent 7. That level of concentration can conceal what is happening beneath the surface, and it can amplify drawdowns severely if leadership narrows further or investor sentiment shifts abruptly. Let me share a story about what unfolds when a concentrated thesis collapses. In the late 1990s, a fund manager named Alberto Villar ran the Amerindo Technology Fund. It was the top-performing fund in America for 3 straight years. His clients believed they were diversified because they owned a fund. It held dozens of positions spread across numerous companies, but all of them were correlated, all riding the same wave of internet infrastructure optimism, all tied to the same narrative that bandwidth demand would grow indefinitely and the companies supplying it would compound forever. When that narrative fractured in 2000, the fund lost 85% of its value over 3 years. Not because every individual company collapsed, but because when the tide recedes on a concentrated narrative, everything retreats simultaneously. The $500 stock and the $20 stock both arrive at roughly the same destination, dramatically lower. One downside scenario assumes that artificial intelligence investment becomes excessive, triggering a sharp contraction in business spending in 2027 as companies reassess genuine demand for related products. Real business investment is projected to decline by 3.2% in 2027. Companies are increasingly accessing financial markets to fund AI-related investments, which could generate negative spillover effects if they are unable to service their debt. I am not forecasting an AI bubble. I am describing the mechanism. If the narrative currently supporting 40% of your retirement account's market capitalization were to face a serious credibility challenge, the escalator accelerates rapidly. At the conclusion of the S&P 500's final quarter of 2025, the index was trading at 21.6 times its projected earnings. That figure exceeds the 5-year average of 20 times earnings and the 10-year average of 18.8 times. Not a bubble necessarily, but an elevated starting point. And elevated starting points mean that when a recession compresses earnings multiples, which they invariably do, the decline is not neutral. You are beginning from a greater height. The fall covers considerably more distance. By the way, hit subscribe if you find this content valuable. Otherwise, the algorithm may never surface these videos for you again. Understanding these numbers and constructing a system around them are two entirely different things. I sat with this data for some time, and recognizing it changed nothing until I actually built a framework around it. So I created a digital resource called The Exit Code. It contains 8 chapters of concentrated research. No filler, no motivational padding, no vague guidance. 50 years of actual retirement data distilled into a mathematical framework for transforming someday maybe into a concrete specific date. 2 elements of the resource connect directly to what I am describing in this video. The first is what I call the 4% trap, which addresses why the most widely cited retirement withdrawal rule was built on assumptions that no longer apply in 2026, and the dynamic withdrawal method that replaces it, which adjusts based on market conditions so you never fall into the forced selling spiral we are about to discuss. The second is the lazy portfolio, a historically back-tested allocation that has outperformed most active managers over 30-year windows with reduced volatility, without requiring you to monitor a financial terminal continuously. You can access it for less than the cost of 1 hour with a mediocre financial advisor through the link in the description. Every year you delay, the mathematics of compounding works against you. That is not manufactured urgency. That is simply arithmetic. Now here's the reality about sequence of returns risk that most financial media describes in a completely misleading way. They frame it as a risk, meaning something that might happen. It is not a risk. It is a mathematical certainty that plays out differently depending entirely on when it strikes, and the gap it creates cannot be reversed once it has occurred. Let me give you the actual numbers. Picture 2 individuals each retiring with $2 million. Both withdraw $80,000 annually adjusted for inflation. Both earn an average of 5% per year across 20 years. The mathematics suggests they should finish in identical positions. They do not. One finishes with roughly $2.4 million remaining. The other finishes approximately $1.7 million less, dangerously close to complete depletion. Same portfolio size, same withdrawals, same average return. The only distinction is the order in which those returns materialized. This is not a hypothetical pulled from a textbook. The S&P 500 returned roughly 17.9% in 2025 on a total return basis, but the journey was anything but linear. The index fell nearly 19% in the first half of 2025 before recovering to finish solidly positive. Anyone who retired in March 2025 and immediately began drawing income experienced the damaging version of that story in real time. They sold shares at the bottom of the dip in March and April. Those shares subsequently recovered, but the person who had already sold them to cover living expenses missed that recovery entirely. It happened in someone else's account instead. Think of it this way. You are filling a bathtub through a faucet while a drain at the bottom slowly pulls water out. When the tub is full, the drain's effect is modest relative to the total volume. When someone suddenly widens the drain opening, that represents a market decline. The water level falls faster, but you still require the same amount of water for your bath every single day. So you draw from the reduced volume. The drain does not close. The pool shrinks further. Each subsequent withdrawal consumes a proportionally larger share. You require a dramatically higher return to recover, not simply the same return that would have been sufficient before the drain widened. And when the faucet flows more generously again, when markets recover, you are operating with less water than everyone who was not forced to drain during the crisis period. Imagine a sustained market downturn depleting your savings in the years surrounding your retirement, forcing you to liquidate stock at a loss simply to meet ordinary living expenses. Even when the market eventually rebounds, strong returns applied to a shrunken investment base cannot make you financially whole again. Retirement security gets permanently undermined right from the beginning. That possibility carries the name sequence of return risk, and it can strike within a danger zone spanning 5 years before retirement through 5 years after. 5 years before and 5 years after. Right now, more Americans are simultaneously inside that window than at any other moment in the nation's history. This creates a sequence of returns risk for those retiring in 2026, where a market downturn during the opening years of retirement can permanently diminish a nest egg that never accumulated sufficient time to grow adequately. Permanently. That single word is carrying enormous weight in that sentence. During the accumulation phase, permanent loss is nearly a theoretical fiction. You continue contributing. Time heals the damage. The market recovers and pulls your balance along with it. In the distribution phase, permanent is precisely accurate. You liquidated those shares at the bottom. They belong to someone else now. The recovery compounded inside their account, not yours. And here's the reversal that most people have not incorporated into their planning. You believe the problem is a falling market. The actual problem is that a declining market combined with mandatory withdrawals from it creates a self-reinforcing mechanism that locks in losses no amount of patience will ever repair. Among 401k participants approaching retirement, specifically those aged 56 to 65, average account changes during the 2008 crisis ranged between a positive 1% for short tenure individuals to losses exceeding 25% for those with extended tenure. The people damaged most severely in 2008 were those nearest to the exit. But those individuals still held jobs. They absorbed the paper loss while continuing to contribute. The structural distinction today is that the people absorbing a potential recession impact are not near retirees with employment income. Millions of them are actual retirees possessing no income source beyond their portfolio and Social Security payments. They cannot wait it out. The option of staying the course simply does not exist for them. Because staying the course for someone in mandatory distribution mode means selling equities at whatever price the market currently offers to cover next month's expenses. Retirement often arrives earlier than planned due to health deterioration or caregiving obligations. Dave, the individual I introduced earlier, is 58. He planned to retire at 63. But research I examine in detail elsewhere indicates a 58% probability that workers over 50 who depart their jobs voluntarily or involuntarily will never return to full-time employment at comparable income levels. A recession striking his employer may not terminate Dave outright. It will restructure operations. It will present a severance package. And Dave, at 58, with $400,000 in his 401k and 2 teenagers still living at home, will face the decision of accepting that package or gambling on locating equivalent employment in a recession-era labor market. Most people in Dave's position accept the package, and suddenly they are in withdrawal mode at 58, not 63. They just extended the distribution phase by 5 years without contributing a single additional dollar to the accumulation side. Now let us address the 4% trap. This is precisely where standard financial guidance fails at the exact moment you need it most. For 3 decades, the central principle of retirement planning has been the 4% rule. It was developed in 1994 by a financial planner named Bill Bengen. The concept is elegantly simple. Withdraw 4% of your portfolio in year 1, adjust that dollar amount upward for inflation every subsequent year, and historically, you would never exhaust your money across any 30-year period covered by the available data. It became the foundation of every retirement calculator, every advisor conversation, every HR onboarding brochure ever produced. 4%. That was the definitive number. Researcher Bill Bengen established that guideline back in 1994. In 2021, against a backdrop of historically suppressed bond yields and elevated equity valuations, Morningstar chose to reassess Bengen's original work. Their inaugural research concluded that 3.3% represented a more realistic estimate of a safe starting withdrawal rate in 2021, assuming a balanced portfolio, inflation-adjusted fixed withdrawals across a 30-year retirement, and a 90% probability of success. 3.3, not 4. On a $500,000 portfolio, 4% equals $20,000 per year. 3.3% equals $16,500 per year. That $3,500 annual difference represents the gap between a comfortable and an austere retirement for millions of Americans. And it compounds in the unfavorable direction the longer you remain alive. Morningstar subsequently updated that figure again. Morningstar reviews the 4% rule annually based on prevailing market conditions, and now states that for a typical person retiring in 2026, the safest sustainable starting withdrawal rate is actually 3.9%, not 4%. Still not 4. And even 3.9% assumes conditions that are increasingly failing to hold true in 2026. It assumes your portfolio is invested in a reasonably balanced proportion between equities and fixed income. It assumes bond interest rates are generating meaningful returns. Most individuals in standard target date funds are carrying heavier equity exposure than they realize, particularly after the multi-year bull market that inflated equity valuations and progressively shifted allocations further toward stocks. And here's the compounding problem layered on top of the compounding problem. Inflation was running at 3.8% as of April 2026. When you are withdrawing 4% from a portfolio that is simultaneously shrinking by 3.8% in real purchasing power terms due to inflation, your nominal withdrawals compound upward while your portfolio's real value continuously erodes. In a high inflation environment, withdrawing larger amounts at the start of retirement simply to maintain lifestyle pace, particularly when markets are simultaneously declining, can push retirement planning permanently off course. Someone who began withdrawing $100,000 annually would be drawing $114,490 in year 3, following 2 consecutive years of 7% inflation. That trajectory becomes extraordinarily difficult to sustain as each subsequent year builds upon those already elevated withdrawal amounts. This is essentially the 1970s scenario, and most people under 45 possess no intuitive understanding of it because they have never personally experienced it. A couple who retired in 1966 with a $250,000 portfolio, equivalent to roughly $1.8 million in present-day dollars, and followed the 4% rule, did not financially survive the 1970s. Inflation exceeded 9% for multiple consecutive years. Their nominal withdrawal requirements escalated accordingly. Their equity portfolio collapsed during the stagflation bear market. Their bond holdings lost value as interest rates surged sharply. By the late 1970s, the portfolio was entirely depleted, not because of below-average long-term returns, but because sequence risk struck during a period where inflation and poor equity performance arrived simultaneously. And the structural environment today carries meaningful similarities to that era. Goldman Sachs projects that the current tariff regime will elevate inflation by approximately 1% between the second half of 2025 and the first half of 2026 relative to its counterfactual path. That is on top of inflation already running above the Federal Reserve's target. Energy prices have increased. Energy markets have introduced another layer of pressure in 2026. Gasoline prices have risen since developments involving the United States and Iran created disruptions around the Strait of Hormuz, a critical global shipping corridor for oil transport. None of these factors are catastrophic in isolation. Together, they form a compounding setup with serious implications. Here's what all of this means in concrete terms for an actual portfolio. Let me introduce Jennifer's situation. Jennifer is 59. She works as a mid-level manager at a healthcare company and plans to retire at 63. She has been financially disciplined. Her 401k balance at the end of 2025 was $480,000. She carries no debt. She intends to claim Social Security at age 67, which will provide approximately $22,000 annually. Her anticipated annual spending in retirement is $64,000, covering housing, healthcare expenses before Medicare eligibility, food, modest travel, and an emergency reserve. Scenario 1. The market cooperates during her first 3 years. The portfolio compounds at historical averages. She withdraws approximately $20,000 per year before Social Security begins, roughly 4.2%. By age 67, her balance has grown to approximately $510,000. At that point, she requires only about $42,000 annually from her portfolio, supplemented by Social Security income. The mathematics work. The probability of depleting her money before age 85 sits around 15%. Scenario 2. A recession strikes in year 2 of her retirement. The S&P 500 drops 30%. Her $480,000 balance becomes $336,000. She still requires $20,000 that year. That $20,000 now represents nearly 6% of her post-crash balance, not 4.2%. She is forced to sell shares at the worst possible moment. Those shares are permanently gone. In year 3, the market recovers 15%. 15% applied to the $316,000 remaining. After her withdrawal generates $47,400. She sits at approximately $363,000. She is permanently impaired by roughly $117,000 simply because the recession arrived in year 2 rather than year 7. The market did not deliver worse performance over the full 20-year window. Only the sequence differed. That $117,000 gap, compounding at a modest 6% annually over 20 years, represents approximately $375,000 in lost terminal wealth. Jennifer does not retire in poverty. She retires under financial stress. She reduces spending. She postpones a medical procedure. She visits her grandchildren less frequently than she had envisioned. None of that damage appears anywhere on a standard portfolio projection. Meanwhile, Jennifer's advisor presented her with an average return projection. The average return in Scenario 2 was perfectly acceptable. The sequence simply was not included in the slide presentation. Now, here's something the aggregate retirement data is already signaling before any recession has been officially declared. 6% of workers inside Fidelity's plan universe took a hardship withdrawal in 2025, up from 4.8% in 2024, and roughly 2% before the pandemic. It marks the 6th consecutive annual increase since 2018, when Congress relaxed hardship withdrawal rules. 6% may not sound alarming on its surface, but the trend line is impossible to ignore. The median hardship withdrawal was just $1,900, with avoiding foreclosure or eviction, and covering medical expenses ranking among the primary reasons cited. These are not irresponsible individuals raiding retirement accounts for leisure. These are people whose financial margin has eroded to the point where the retirement account represents the only accessible asset remaining, and that account carries a 10% early withdrawal penalty plus ordinary income taxation on top of the amount withdrawn. A $1,900 hardship withdrawal from a 401k for someone in the 22% tax bracket costs approximately $2,500 in real economic terms, permanently eliminates the compounding power of that money, and contributes essentially nothing meaningful toward resolving the crisis that triggered the withdrawal. More than 1 in 4, specifically 25.9%, of Generation X workers currently carries an outstanding 401k loan, exceeding the overall percentage of plan participants with loans outstanding as of the third quarter of 2025.